Hey investor friends, I'm Michelle Markey, and today I'm going to talk about the crazy trading bonanza that happened a few weeks ago between people on Reddit subpage WallStreetBets, GameStop, the company, and Wall Street's hedge funds. And if you're a kid and you remember buying video games like the Super Nintendo, Zelda, and Final Fantasy II, you might have gone to the precursor of GameStop known as Babbage's, and then it became GameStop, which kind of reminds me of another Dallas, Texas-based company that became defunct known as Blockbuster, and many pundits thought the same fate that happened to Blockbuster would sadly happen to GameStop. And some of the signs are not so great for many stores that exist for GameStop and which are sadly closing down. But there have been some cases made that a GameStop is trying to turn things around by making some of their stores more social to accommodate things like esports. And if we hadn't had the coronavirus pandemic, they might have made better headway so that Wall Street wouldn't be so bearish on GameStop. But for now, let's talk about what we learned from this crazy trading situation that happened and the implications and resulting fallout, and also some good news that happened out of this whole thing. So please enjoy. Whether you're more of a trader who likes to buy and sell stocks for a short-term gain or an investor who likes to buy stocks to invest for the long term, I'd love if you could please like and subscribe. Thanks. Fortunately or unfortunately for me, I'm not that into gambling, and I learned about this David and Goliath phenomenon on Wall Street Journal one day during the week of January 25, and when I learned about what was going on, I found it interesting, but it didn't compel me to want to go onto Reddit and learn about it to go see if I would want to take some action. I kind of just casually read articles that week about what was going on, and I'd heard that WallStreetBets on Reddit had been closed to new members, so I kind of waited until much later on to go check it out. But I admire kind of what's gone on, the epic saga that unfolded. And another person I know who's not that into gambling is Warren Buffett. And back in his Berkshire Hathaway 1987 annual letter, it's almost like he was talking about what was going on recently. And I'll read some of it to you. He said, "Many commentators, however, have drawn an incorrect conclusion upon observing recent events. They are fond of saying that the small investor has no chance in a market now dominated by the erratic behavior of the big boys. This conclusion is dead wrong. Such markets are ideal for any investor, small or large, so long as he sticks to his investment knitting. Volatility caused by money managers who speculate irrationally with huge sums of money will offer the true investor more chances to make intelligent investment moves. He can be hurt by such volatility only if he is forced by either financial or psychological pressure to sell at untoward times." And that basically means selling at times that the retail investor wouldn't want to sell, or in the case of recent events, the hedge funds that had to close their short positions a little sooner than they would have liked. And I'm amazed how prescient Warren Buffett was about this very event. It's as if he was talking about this whole GameStop thing back in 1987, which is amazing. At the height of what was going on, a lot of people were trying to figure out what is short selling and what is a short squeeze. And I'll explain with two GameStop stock graph examples. And the first one is about short selling. So in short selling, a trader decides that the stock is overvalued, and then that short seller wants to borrow the stock from a broker just so that person can immediately sell it at a higher price on the open market, such as, let's say, $11.50 on March 13, 2019. And they eventually have to return the borrowed stock to the broker, but not yet. And then later on, some time goes by, the short seller can buy back the shares at a lower price and return the borrowed shares to the broker, thereby making a profit in the decline of the stock price. So in this example, on August 15, 2019, if the price hit $3.20, the short seller could have made $8.30 per share on this decline with the short selling trading process. And it can even be exaggerated when you involve options. So I'm not going to get into that now, but the effects of short selling can be magnified with the introduction and use of options or derivatives. And then on to the short sell squeeze example. In here, we look at how conveniently on November 5, 2020, the stock of GameStop was trading at $11.50 again. And let's say someone had been trying to still sell that stock shorter and sell the stock for some price below $11.50. But instead of that happening, it kind of just went sideways for a little bit until gradually more and more traders piled in to cause GameStop to launch like a rocket ship to reach a high of $483 on January 28, 2021. And in this mathematical example, it could have caused a short seller to have lost $471.50 based on this pretty crazy example. But the thing is, a short seller could technically lose money infinitely if the stock price kept going up. But it turns out that some of the brokerage firms put a halt to people being able to buy more of the stock because a lot of us know that the fundamentals of this company are not so great. So it's super difficult to justify this kind of valuation and price for a stock at this current level. But it doesn't mean that it couldn't keep going up depending on how many people, or the wisdom of the crowd as they call it, if that wisdom of the crowd values the stock at a higher price. Technically, short sellers could infinitely lose money, and what also compounds the pain for short sellers is that it also means if they've used options in this case, they have to close their position at amounts that just make them have to buy the stock back at a higher price. And that is just so difficult for them. So many hedge funds that were shorting the stock were in a lot of pain as a result. This broadcast is brought to you by the zero commission fee, game-like design with fireworks upon transactions, highly addictive, new favorite pandemic pastime, Sheriff of Nottingham trading and investing app. Just kidding. I'm just joking and being facetious. I learned so much about what articles, podcasts, and videos said about what transpired. And one of the lessons I learned that stands out to me is what Chamath Palihapitiya said on CNBC when he said that this was a retail revolution in which there's a lot of pushback against the Wall Street establishment, where there were people who did due diligence of conducting fundamental analyses of how GameStop might have long-term value, as well as there were other stocks involved. It wasn't just GameStop, by the way. And the other points were that there were a lot of kids who have memories of going to GameStop back when they were much younger and during the great financial crisis when a lot of families were losing their homes and people didn't feel like the common people were helped out in some of the financial crises back then. And these people did a lot of their own research and made up their own minds even after reading all kinds of information on something like Reddit, a really big wide open forum, and something like WallStreetBets, which is proud to be known as a community of degenerates, and they pride themselves on making fun of each other for losing money. So I like how Chamath was defending the common people and talking about this really glorious epic saga of what transpired. And I wanted to put together my own timeline of my understanding of what happened. And I go back to a lot of events that happened even before this past January to early February 2021. My timeline of the epic saga starts out with what a lot of people have deemed as the antagonist in the story, or Melvin Capital Management LP. And I'll take you through some of the U.S. Securities and Exchange Commission website information about what I learned dating back to approximately June of 2019 and probably before that, but here's where I'm going to start our story. And our protagonist in the story is commonly known as Keith Gill, or on Reddit, Deep Effing Value, I added a euphemism in there, and on YouTube as Roaring Kitty. So here we go. What I wanted to figure out is, how do we even know what some of the hedge funds on Wall Street are fully invested in, or what their activities might be? And this is where the U.S. Securities and Exchange Commission, or SEC, requires that institutional money managers like hedge funds file a form called 13F every quarter, and this is for any funds with assets under management of $100 million or more, and it shows what are some of the equity holdings and what activities there are in securities that these funds are up to. So I did a search in the SEC website for Melvin Capital Management LP, and then proceeded to look through the results, and then I narrowed the results further by looking for just the 13F form. And then when I came across the 13F form, I tried to figure out what exactly am I looking for in these results, and I came across a list of specs and answers as to what to look for in something called an info table, and it contains descriptions of the securities and amounts and values, and a lot of it's still very confusing and hard to decipher. So I hope the SEC comes up with more of a in-depth FAQ, as well as more descriptions of what is meant in the info table spec table. But in any event, I then went to the June 30th, 2019 XML file turned into Excel. I could see how Melvin Capital Management has a certain number of puts on GameStop, and they have some puts and calls on some other stocks. And similarly, when I looked at the September 30, 2020 13F filing for Melvin, I could also see how, in addition to GameStop, they seem to have more puts on GameStop by now in the latest filing I could find on the USC Edgar search. They also had 16 other stocks on which they seem to be doing some kinds of puts on, and then they had a number of others that they're doing calls on. After navigating a few other websites like Whale Wisdom, I finally came across where probably would have been an easier place to know how much certain stocks were being shorted. And it was actually from a Roaring Kitty video that I found this highshortinterest.com table from August 2020. So that would have been helpful in even knowing to begin with what stocks a lot of hedge funds might be shorting, and that could have saved me some time from going through the SEC Edgar search. Anyway, back to the timeline. So fast forward to September 2019, where I see that Keith Gill as DFV on Reddit posts sarcastically thanking Michael Burry for jacking up his cost basis, as in, because Michael Burry was also investing in GameStop and so was Keith Gill, it caused his cost basis to maybe go up because he wanted to buy more of the stock. And I also saw his positions that he shared starting from that point. I mean, maybe he shared it at an earlier point, but that's the earliest that I could see. And then I also see him posting his GameStop positions after Q2 earnings that same September. And then you go on to also see many more posts in the year 2020 of Keith Gill's Reddit username posting every so often his GameStop positions. So he's actually been at this for quite a bit, and in his Roaring Kitty YouTube channel, I noted in August 2020 how he talks about his bullish case for GameStop and how he thinks that it's more of a roach instead of a cigar butt. And similar to how Warren Buffett invests, he wants to buy GameStop for the long term, and he makes a pretty good case for it as to why it could be a pretty good long-term value item to buy. And he also talks about how he noticed a lot of short positions on GameStop and how it could potentially lead to a short squeeze. So it's like he was predicting back in August of 2020 what ended up happening in January and maybe early February 2021. As we all know, this came to a flaming crescendo in January 2021, where Keith Gill as DFV on Reddit was posting almost daily GME YOLO posts showing his GameStop positions. And the price went from something below $50 to into the $300 range. And I read somewhere that it had even hit $500 pre-market, and the intraday high that it had ever reached was $483 on January 28. And it just so happened that GameStop was being traded at 140% of its public float being sold short. And that means that hedge funds were trading on so much borrowed money or margin that they had been even borrowing to sell short 40% more than had existed of public shares of GameStop. So 140% of GameStop being sold short was insanity, and no wonder the price had skyrocketed the way it did. And then it led to Melvin Capital closing their position on January 27. And then following January 28, a lot of people were restricted from being able to buy more of GameStop and other stocks. So common brokerage firms like Robinhood, Charles Schwab, TD Ameritrade, and Interactive Brokers actually halted traders' ability to keep buying the stock. And a lot of them would only allow people to sell it from a certain point on. And this also happened with some other volatile stocks that the brokerage firms deemed to be in danger. And there's definitely some controversy here about the motivations behind some of this. And then needless to say, there were class action lawsuits that were filed against Robinhood and probably some of the other brokerages for restricting people from trading. So it shows that at the height of all this insanity, when people are trying to do certain things, we see kind of how the power unfolds and what shakes out in the aftermath. It wouldn't be an epic saga without some heartwarming tales too. And some people were smart and were able to make some money such that they could pay off their student loans, like this one Redditor posted about, or how Reddit decided to rent out a 5-second ad for Super Bowl 55 or LV on February 7 and talk about how even the underdogs can accomplish a lot of things in the pursuit of a common idea. And this is also something like how Danielle in Philtown would call voting with our money for a mission. And all these Redditors believed in this mission. So I think that they have a lot to be proud of, and hopefully a lot of them didn't lose too much money, because that would be something to shed a tear about. And there's not all just puppies and roses at the end of the story. There's also, unfortunately, some other things to have to deal with, like how there's a February 18 congressional hearing on the incident, as well as how there's going to be taxes for people who made short-term capital gains. So keep this in mind as to maybe you might have been doing some short-term trading last year, and there will be some taxes that need to be dealt with in capital gains profits that you might have made, and which may be taxed at your current income bracket. If you had long-term capital gains, you would be taxed at maybe 15%. If you made a significant amount of money, maybe some of your long-term capital gains would be taxed at a higher amount. But for the most part, a lot of people who do short-term trading will have capital gains or losses that would be taxed at the income tax bracket you're in if you made gains. But if you had losses, you can claim those actually against your taxes. And again, not advice. I'm not an accountant or not someone who deals in taxes, so I'm not recommending or giving advice for you to do anything here with your taxes. But also keep in mind, according to this money article also, that there may be this obligation to pay taxes in a quarterly amount. And so just keep some of this information in mind if this situation applies to you. I'd like to think one of the few downsides to this GameStop gamble was just the people who came to the party late and they didn't leave in time. And then they suffered losses like you wouldn't believe. And then the other thing that the Wall Street Journal actually published on February 12 talks about why women supposedly won't embrace investing and investing in equities specifically. And the article talks about how women tend to invest in cash, real estate, bonds, but somehow are afraid of investing in stocks. and they talked about how there may have been some female Redditors who kind of felt like there weren't that many of them on the WallStreetBets subreddit page. And that's probably true, because maybe it's not so fun to be gambling our money. And I think that women actually would be interested in investing in equity, but we need to talk about the subject in a way that it makes sense to be investing similar to the way that Keith Gill evaluates companies for the value that they have based on the research that he did, thinks that the company can thrive into the future. I think women can get behind something like that and be willing to vote with their money for companies they can believe in and that have good fundamentals and aren't just being played around like a football between Reddit and Wall Street. But I think women actually can and would like to be investors. And I just think that an article like this doesn't really give women a great reputation for what they can be. I think women already are investors, and that women will continue to become better investors, and it's okay to sit out on the bench and miss out on something like the GameStop roller coaster. I'm actually glad that I didn't even participate and didn't think about trying to bet with any other stocks, and there were so many more that will happen in the aftermath. And like many commentators and pundits have talked about, I mean, there will probably be regulatory implications from all this, but nonetheless, I'd like to encourage everybody to invest wisely, and I really hope that you learned something and enjoyed this video, and I hope you'll please like and subscribe to my video and YouTube channel, and I wish you well on your journey towards financial freedom. Thanks for watching, and till next time,